Welcome back. In this video, I want to talk about foreign withholding taxes, specifically what they are, how they affect your portfolio, and how you can avoid paying them if you can. So first, what is a foreign withholding tax? Basically, it's a tax on foreign investors. Many countries do charge a foreign withholding tax on foreign investors if they've received a dividend from their country. So the ones that I'm going to specifically talk about are the US foreign withholding taxes on Canadians. Why would I talk about the US foreign withholding taxes? Well, that's because Canada and the US have a deal in which we can avoid paying some of these foreign withholding taxes. Generally, Canadians are charged a foreign withholding tax of 15% on all the dividends received from an investment in a US company or stock or ETF or anything like that. But the treaty here in Canada with the US states that if you do hold a US currency ETF or stock in your retirement portfolio, you do not have to pay those foreign withholding taxes. Now, what is a retirement portfolio? Well, the US says that only the RRSP and the lira count as retirement portfolios. So on TFSAs or RESPs or any non-retirement portfolio, you will have to still pay the 15% foreign withholding taxes on dividends. So in general, what does the 15% foreign withholding tax mean to investors? Really, if you have a US ETF or stock that pays out a 2% dividend, that foreign withholding tax will add 0.3% fees on that portion of the portfolio. And that can really add up, 0.3%. That's higher than many MERs on these index ETFs that I've been talking about. So let's look at some examples here. So I've chosen to use 8 ETFs here as our comparison. Really, there's only going to be 4, and I'll explain that here in a second. I've chosen Vanguard and iShares portfolios here as our demonstration. The reason I've chosen Vanguard and iShares is because they have a large presence in both Canada and the US. And you'll see there's a lot of similarities to what they've done here. And so it's a really nice comparison tool. And that's just why I've chosen these 8 ETFs here. So you can see here, let's look at Vanguard's first here, the Vanguard Total Stock Market ETF, ticker VTI. VTI is an ETF in the US, held in obviously US currency, and it has 3,598 holdings as shown here. And that basically just means all the stocks in the US, basically. It's a total market ETF. So all your small caps, all your mid caps, all your large cap companies, any company you can possibly think of in the US is going to be held in this ETF. And you can see here, US ETFs have a much lower MER than here in Canada. This one is sitting at 0.03%, and all these US currency ones are sitting that low. And they have a similar one here in Canada, Vanguard US Total Market Index ETF, ticker VUN. It's held in Canadian currency. And you can see here in brackets, it has the exact same number of holdings as VTI, 3,598, and it's got a slightly higher MER. And here you can see there's actually one holding, but there's 3,598 underlying holdings, and I'll talk about that in a second. And iShares Core S&P Total US Stock Market ETF here, iTote. Again, just iShares version of the total US market. You can see here 2,438 small caps, mid caps, large caps companies, same MER as the VTI. And iShares has their Canadian currency version of that XUU. And you can see here, same amount of holdings, but again, really there's only one holding. We'll talk about that in a second. Slightly higher MER. And again, I say slightly higher. There's only 0.04%. That's double what the US version is. But again, you're holding it in Canadian currency. If you're looking to invest in just the large cap companies, Vanguard has VOO and iShares has IVV in the US. Those basically hold the 500 largest companies in the US. It just follows the index S&P 500. And you can see that they have their Canadian versions as well, VFV for Vanguard and XUS for iShares. And again, very low MERs, but again, triple what they are in their US counterparts. So the reason I'm using these as their comparisons, it's because of their underlying holdings. So I'm just going to use BMO's comparison tool again. If you've watched my videos, you know I love this site. I've got the Canadian versions of the total market and the S&P 500, VUN, XUU, VFV, and XUS here. You can see here under the number of holdings again, there's actually only one holding for 3 of these 4. The exception is XUU. It says 122, and I'll talk about that in a second. But if you scroll down to its holdings, you can see that VUN, VFV, and XUS actually only have one holding. And so VUN only holds one item, and that is VTI. So when you buy the Canadian version, VUN, from Vanguard, you're actually just buying the VTI. So the ETF VUN holds VTI. That's the only holding. VTI happens to hold 3,598 holdings, and that's what's happening underneath the surface. Let's say you purchase VFV. Really all you've done is purchase VOO. And VOO, again, holds the 505 largest companies in the US. So it's a way of buying all of those in a Canadian currency. That's why I've used these. Basically, they're the exact same because the Canadian version just holds the US ETF. And that's why the MER is slightly higher because of the currency conversion and all that sort of stuff. So now, getting back to the foreign withholding tax, I'm using the 12-month yield for each of these. I realize that dividends and distributions don't work exactly like this, but for the sake of this video, I've just gone to the fact sheets and I've looked at what over the last 12 months, what was the dividends or the distribution for each of these ETFs. And you can see that over the last 12 months, VTI has paid out about 1.36% of how much you hold in VTI. Again, for the sake of this video, if I put in $10,000, then I'm just going to assume that 1.36% of the $10,000 gets paid out as a dividend. And here I've got the fees. This will combine the MER, the management expense ratio, with the foreign withholding taxes. So all your fees combined. And I've got the 2 columns, one for your retirement, or what the US considers our retirement portfolios. So the RRSPs and the liras, and also the RIFs and the LIFs. RIFs are just the withdrawals of the RRSPs, and LIFs are just the withdrawal account of the liras. And then I've got some of your other registered accounts that don't count as retirement portfolios. So let's say you were looking to put in $10,000 into your US equity portion of your portfolio. And you can see here in the TFSA, the RDSP, and the RESP that the fees are basically the same. And you can see there's a slight difference in the USD version compared to the Canadian version. And that's just because the MERs were slightly lower with the USD version. But you can see here with the retirement accounts that the fees are a little bit different. So you can see for VTI and ITOT and VU and IVV, you're only paying the MER. So that's 0.03%. But with the Canadian version, VUN, XUU, VFV, and XUS, you actually have to pay the MER plus a foreign withholding tax. And right now, if you only had $10,000 invested in one of these, I mean, $30 per year on $10,000 invested isn't that much. But let's say you increased your portfolio to $100,000. Now the fees are starting to look a little different. Now you're paying between, say, $225 to $300, depending on which ETF you're holding, compared to just $30. And let's say your portfolio continues to grow. Now your US equity portion of your portfolio grows to, say, $250,000. Now the fees are starting to really add up. You're looking at almost $600, $700 in fees compared to $75 per year. And again, that's going to compound every year. You could have invested that extra $500 or $600 into the market, and that would have grown more and more as well. So you can see that the higher your portfolio, the more of a difference these foreign withholding taxes are going to make. I should note that I'm just talking about some registered accounts here. If you do invest in a non-registered account, some of these foreign withholding taxes are recoverable. You'll receive a T5 statement during tax time, so you will have paid those fees, but during tax season, you can recover those foreign withholding taxes and get that money back. So I've focused just on the registered accounts. Justin Bender had a great series on foreign withholding taxes, and he talks about level 1 and level 2 foreign withholding taxes, and it gets pretty elaborate, and I didn't want to go there for the sake of this video. But he had a list of ETFs which would reduce your foreign withholding taxes as much as you could. And so in the RRSP and the Lira, he suggested holding your USD ETFs. So he suggested VTI and ITOT, but you could do the VU and the IVV. It doesn't matter. You're saving yourself about 0.3% per year. But for your international equity portion of your portfolio, because we don't have a treaty with any of those countries, it didn't really matter. So he suggested just holding your Canadian currency version of an ETF. And so he suggested XEF, VIU, or ZEA. He did say that if you invested in something like IEFA, it was a US currency ETF, and no advantage with the foreign withholding taxes. But again, the MERs are slightly lower. So if you're looking to cut back on your fees, you could purchase IEFA, but it really didn't make too much of a difference. Now you can see with all of the other accounts, if it wasn't a retirement account or what was considered a retirement account by the US, then it doesn't matter. So he suggested just pick your Canadian currency versions, and that would be good enough for your TFSAs, your RESPs, all of your other accounts. So again, if you're looking to save some fees on your portfolio, then saving them on foreign withholding taxes by keeping US currency ETFs in your RRSP is one way you can do that. And for my wife and I, all of our RRSPs hold VTI. So we've decided to convert our Canadian currency to US currency and purchase VTI. So our RRSPs are 100% VTI. I'm not recommending VTI, it's just what we chose. Our portfolio is still 25% Canadian, 50% US, and 25% international equities, but we treat all of our portfolios, our TFSAs, our RRSPs, and our non-registered as one, and for the most part, that 50% of our US equity is held in our RRSPs. And I'll have a video showing how our portfolio is broken up to save the most amount of fees for us. So again, is it worth it? That's up to you. If you have a smaller portfolio and you're not comfortable with converting with some brokerages, you're going to be paying a conversion fee as well. So that could be 1.5%, could be up to 2.5%. Is it worth it then? You'd have to crunch the numbers. If you're doing Norbert's Gambit with Questrade, you can reduce those fees. Are you comfortable with using Norbert's Gambit? There's all these questions that you have to ask yourself whether saving these foreign withholding taxes is worth it for you. To me, saving every little fee I can is worth it to me most of the time. But I love spreadsheets, I love rebalancing, I love playing this game of saving the most money. I realize that I am an outlier. So if you've enjoyed this video and would like to stay informed of some of my other ones, please subscribe below and have a wonderful day.